In this video, I'm going to show you how you can make $5,000 or more using my favorite strategy for safe and consistent income selling cash secured puts. So whether you're looking to retire early or build a side income alongside your 9 to 5, this video is for you. I'm going to show you my exact thought process for stock selection, trade entry, and even the strike price that I choose for selling these put options. Let's go. Hi, my name is Gautam, and on this channel, I talk about the stock market and achieving financial freedom with the power of options trading. So, if you enjoy content that can help you retire early and achieve financial freedom, don't forget to hit that like button, subscribe to my channel, and share this video with your friends and family. Also, if you are new to the options world or are simply looking for one-on-one guidance to help you shortcut years of trial and error and avoid costly mistakes, click on the coaching link below and I'll be honored to help you out. Now, a quick disclaimer before we get started that the information provided in this video is for informational and educational purposes only. I'm simply showing you my trades and how I trade, and I'm not a licensed financial advisor. With that said, let's jump in and understand the actual strategy. A cash secured put is an option strategy where you sell a put option at a set price, also known as a strike price, for a set time known as the expiration date. In return, you receive a premium for taking on this obligation. It is also known a cash secured put because you need to come up with the collateral to open this trade, which is basically the cost of buying the stock if assigned. Now let's look at some of the benefits of the strategy and why I like it. So obviously we like the strategy for making money. So you will make money as long as the stock stays above the sold strike price. And we also benefit from time decay, also known as theta decay, as the seller of the options contract, because the value of the options contract continues to decline as it gets closer to the expiration date. Now, in case the stock falls below the strike price of your sold put and the option is exercised, you get to buy your favorite stock at a discount. So let's assume Apple's trading at $200 and you sell a 190 strike price put option expiring for the following week. Now, at expiration, if Apple is below $190, then you will get assigned at the 190 strike price, no matter what the current price of Apple is at that point of time. So when it comes to risk management and the fact that you can be assigned, you always want to run the strategy on a stock that is fundamentally strong and that you believe in. Let's look at my stock selection criteria for running cash secured puts. So it goes without saying that you obviously want to run the strategy on a stock that offers good premiums because you're putting your cash as a collateral. So you want to make sure that you collect a decent premium for putting your collateral on the line. And for me, a decent monthly premium is anywhere from 2 to 5% for putting my collateral on the line. Secondly, you want to choose a stock that has strong fundamentals, meaning that it has consistently shown to beat earnings quarter over quarter and it has great future growth prospects. Obviously, you want to run the strategy on a stock that you're comfortable owning if assigned, because if the price of the stock falls below the sold put, if it's a stock that is fundamentally strong, it'll eventually come back up and you're not going to be left bag holding. Last but not least, you obviously don't want to run this strategy on a meme stock just because it's popular and is offering great premiums, because that'll absolutely guarantee that you'll be bag holding for a while. So now that you understand how cash secured puts work and my exact criteria for stock selection, let's go ahead and simulate some potential trades to show you how you can make $5,000 a month selling cash secured puts. My first pick is SoFi Technologies, and if you look at SoFi and where it's trading right now, it's in between the top and the middle of the Bollinger Band. So for those not familiar with the Bollinger Bands are a technical analysis tool. A stock generally tends to trade within the Bollinger Band 95% of the times. So if I jumped out of the Bollinger Band right here, and then a few days later, it came back under the Bollinger Band, and then same thing right here. We saw on September 22nd that SoFi jumped above the Bollinger Band, made a new high of $30.30, and then just a few days later, reverted back under the Bollinger Band. So that's how Bollinger Bands work. Looking at where SoFi is trading right now, it's right in the center of the Bollinger Band. And the next obvious level of support that I see for SoFi is actually this 50-day moving average, which is about $24.50. So let's go ahead and pull up the options chain and see what kind of premiums we would collect. So I generally like to sell weekly options, and in certain cases, I don't mind doing monthly options as well. It just depends on the stock and the setup and what I'm looking to achieve. But in this case, since I'm showing you how to make $5,000 a month selling cash secured puts, and we're targeting a monthly income, I'm just going to keep it simple and go about a month out and show you how much premium we can collect. So with that said, I'm going to go to the October 31st options chain, which is about 32 days out from today. So looking at the chart, I said that I like a price anywhere from the $24 to the $24.50 strike price. Let's look at what kind of a delta that is. Now, the $24 strike price is a delta of 22. And simply what that means is that there's a 22% chance of the stock getting to that strike price by expiration. And if we go with the $24 strike price, that is a return of about 3.56% on your capital, which is fantastic. Because as I mentioned earlier, I like a return of anywhere from 2 to 5% on my capital for a month. So the 3.56 is great. I also like the 24.50 strike price. Now, obviously, the closer you get to the current price of the stock, the higher the premium. But because I really like SoFi and I don't actually mind getting assigned at the 24.50 strike price, I'd be comfortable going with the 24.50 strike price. If I click on the bid price, the order ticket opens up and we have a pretty tight bid and ask price. So if I go with the mid price right here, I would receive a $96 in premium for selling one cash secured put at the 24.50 strike price. So what I'm going to do is I'm going to go ahead and load 15 contracts. And then if I sell 15 contracts at the 24.50 strike price and hit review, I would collect a premium of $1,425 selling 15 cash secured puts on SoFi. My next pick is Robinhood, ticker symbol HOOD. And Robinhood is actually up 11.6% today, making a new high of almost $136. And let's see what's been happening. So Robinhood shares hit an all-time high on Monday, propelled by recent positive operational results and strategic growth announcements. CEO Vlad Tenev revealed on social media that more than 4 billion contracts have been traded on the platform since launch. He went on to say that company's total platform assets swelled by 112% to 304 billion last month, and it attracted 4.8 billion in net deposits for the month of August. So obviously with that social media post today, the stock jumped up, made a new high, and then is up 11.8% as we speak. So looking at Robinhood's 6-month chart, we see this big green candle today. So generally speaking, when the stock is up nicely and it's a green day for a stock, is not a great day to sell put options. But for the sake of our exercise, I'm going to show you that looking at where Robinhood's trading right now, which is the very top of its Bollinger Band, I like the middle of the Bollinger Band as the next level of support, which is the 117 strike price. And if we want to be a little safer, I also like the 50-day moving average, which is slightly under the middle of the Bollinger Band, which is this 115 strike price. So let's pull up the options chain. And again, I'm going to go to the October 31st options chain. And then if we look at the 117 strike price, that is a delta of 20. So let's look at the return on our capital on some of these strike prices. If I go with the 115 strike price, we have about a 2.75% return on our capital. And then the 115 strike price is about a $20 discount from the current price of the stock. If we go with the 116 strike price, that strike price gives us about a 2.93% return on our investment. And that is also a delta of 19. So I actually don't mind going with the 116 strike price. It is a delta of 19, and I generally like to sell put options anywhere from a delta of 15 to 20. So that falls in between my risk range. So I'm going to go with the 116 strike price. And then again, if I click on the bid right now, the order ticket opens up. And right now, if I go with the mid price, then I would collect a premium of about $3.25 selling one cash secured put at that strike price. So for this exercise, I'm going to go ahead and sell 3 cash secured puts at that strike price. And then for that, we would collect a total premium of $960, going about a month out to October 31st. My next pick is TQQQ. For those not familiar with TQQQ, TQQQ is a leverage ETF that provides you 3x leverage to the daily movement of the NASDAQ 100 index, also known as the QQQ. If we look at TQQ's 6-month chart, it's right in between the top and the middle of the Bollinger Band. But knowing that it's a leverage ETF and the fact that it can make large moves, I'm going to be cautious with this one. So looking at the first level of support, it would be actually the middle of the Bollinger Band. But the middle of the Bollinger Band is quite close to the current price of TQQQ. So the next level of support that I like here is the 50-day moving average, which is in between the middle of the Bollinger Band and the bottom of the Bollinger Band. So I would start with the $92 strike price and then make my decision from there. So I'm going to go out to the October 31st options chain. So the 92 strike price is a delta of 24. Keeping in mind we have a leverage ETF, I want to be more cautious. So I'm probably going to go with the $90 strike price. This again is a delta of 22, and then this would give you a 3% return on your collateral. And generally speaking, leverage ETFs have a wider bid and ask compared to the actual underlying or the actual stock. So keeping that in mind, if I click on the bid, the mid price in between the bid and the ask is about $2.65, which if you times it by 100, that would be $265. So I'm going to sell 3 cash secured puts at the $90 strike price. And for that, I would collect a total premium of $756. My next pick is Hims. And for those not familiar with Hims, Hims and Hers is a telehealth company with a subscription-based direct-to-consumer business model. It has been in the news for using a compounded version of the weight loss drug Wegovy. It's had quite a volatile run in 2025, but with volatility comes opportunity, and it is one of those stocks that offers great premiums. So looking at where it's trading right now, it's currently closer to the top of its Bollinger Band. So the next level of support that I see for Hims is the middle of the Bollinger Band. Now, the middle of the Bollinger Band is also its 50-day moving average. So there's a lot of support right here. And also, if we see all these candles right here, there's a lot of support further down at this $48, $49 level too. So let's pull up the options chain and see which strike price makes sense. I'm going to go to the October 31st options chain. So if I look at the $50 strike price right here, this is a delta of 22. And right now, this is offering a return of about 4.6% on our capital. So going back to the chart right here, the $50 price level is right in between the bottom of these candles and the middle of the Bollinger Band, which is about 51.89. If I go forward with the $50 strike price, right now I would collect a premium of about $2.22, which equates to $222. So I'm going to go ahead and sell 5 cash secured puts on Hims at the $50 strike price. And for that, I would collect a total of $1,070. My final pick for this video is another leverage ETF, NVDL. Now, NVDL provides you 2x exposure to the movement of the NVIDIA stock. So I like NVDL because it's about half the price of NVIDIA and offers better premiums. With leverage ETFs, I generally like to sell puts on leverage ETFs just for weekly or monthly income. So, not trying to hold them in the long run. If you do get a sign, you can sell covered calls and exit the position for a profit. Because leverage ETFs are reset daily, the performance of a leverage ETF compared to the actual underlying stock over a period of time may vary and may not give you the same results. So the actual stock is a better choice if you intend to get assigned and hold shares. In case you're just looking for weekly or monthly income and are not wanting to get assigned, then I would sell puts at a lower delta than usual. And that way there's less chances of being assigned, and then you can still continue to collect your weekly or monthly income. So having said that, NVDL is trading close to the top of its Bollinger Band right now. So the next level of support that I see is the middle of the Bollinger Band, which is the $83 strike price. And again, because this is a leverage ETF and I want to be a little more cautious, I'm probably going to look for something in between the middle and the bottom of the Bollinger Band, which is probably close to the $78, $79 level. So let's go over to the options chain and see what delta would be 78 or a 79 strike price. So looking at the $78 strike price, that is a delta of 24. So still slightly aggressive for a leverage ETF. So I may settle with the $77 strike price. This is a delta of 22, and then again would be closer to the bottom of the Bollinger Band, and it still gives us a great return on our capital. Right now we have a 3.7% return on our capital. So if I go with the $77 strike price, I would collect a premium of $2.77, which again, would equate to $277. I'm going to go ahead and sell 4 puts at the $77 strike price. And for that, I would collect a total premium of $1,028. So now that I've shown you all the trades, let's look at a quick summary in Excel. The first stock that we went with was SoFi, and then we sold 15 contracts at the $24.50 strike price and collected a monthly premium of $1,425. And for this, we would require a collateral of $36,750, which is simply taking the strike price times the number of contracts, which is 15, times 100 because one options contract lets you control 100 shares. So the SoFi trade would require a collateral of 36,750. So our next stock pick was a Robinhood. And for Robinhood, we sold 3 contracts at the $116 strike price. And for that, we collected a total monthly premium of $960. And again, to put up the Robinhood trade would require a collateral of 34,800. The next trade was TQQQ, and for that we sold 3 contracts and collected a premium of $756. Now, this one required a collateral of $27,000. And for our next pick, we sold 5 put contracts on HIMS at the $50 strike price, resulting in a monthly premium of $1,070. And then this would require a collateral of $25,000. So for the final pick, we did NVDL 4 contracts at the $76 strike price, resulting in a monthly premium of $1,028. And then this required a collateral of $30,400. So as you can see, it would require a collateral of about $154K to come up with $5K in monthly income. And as you can see, that is a fantastic return of 3.4% on average. And what I did was, break down my 154K amongst 5 stocks of my choosing that I like. It's always my goal anytime I sell put options is that none of my positions actually exceed anywhere from 15 to 20% of the total account size. You should adjust this percentage based on the size of your portfolio. If you end up choosing a different variety of stocks, your results may vary and you may get a different return on your capital. So it all depends on the strike prices you pick and the risk that you're willing to take to put up with this trade. So that's it for today's video. If you enjoyed it or learned anything useful, don't forget to hit that like button, subscribe to my channel, and comment down below with your thoughts or any questions. If you would like one-on-one coaching directly with me, click on the first link in the description below, and I'd love to help you out.